mortgage markets and more. I'm your host, Peter D'Angelo. I hope you're doing well and had an awesome weekend. First full week of March, here we come. We got through the one day longer month of February. Looking forward to hopefully some spring weather around the corner. But for now, let's talk about mortgage rates. We're going to start off with a survey of where rates were as they ended off last week. And then we're going to talk about a couple other items. And then we're going to discuss mortgage insurance. What is it? How does it operate? What do you need to know about mortgage insurance if you are a real estate professional or you're looking to buy a home? Starting off with the mortgage rate survey, this is from the Mortgage News Daily survey. They survey a number of different mortgage companies to get a consensus on where rates are and average that out. The 30-year fixed rate mortgage was averaging at 7.1% at the end of last week. We've been seeing that creep up little by little due to the volatility, due to the change in expectation of rate cuts this year. The 15-year fix was at 6.6%. The 30-year FHA was at 6.62%. And the 30-year jumbo averaged at 7.42%. That's a little bit of a jump upwards. Everything other than jumbo is squarely in the past 52-week range, the one-year range. We talked in past episodes about where were mortgage rates bottoming out, where were they hitting their tippy top over the past year. That can give us a sense of possibly where they could be going. And right now, squarely in the middle for everything other than jumbo. So there's room to go up and down if history is any indication. And with volatility still in the market, with quite frankly no idea when there could possibly be rate cuts, the Fed themselves is a little bit split as to whether or not there's any indication of rates coming down this year from the Fed fund rate, their monetary policy discount rate, or if the market will create an environment for lower rates. We're going to have to see how all this pans out. But what we've seen now, as the year started out, was rates going down to start off the year, ending off last year, and now creeping up little by little. And it looks like we may be settling, but time will tell. We're in the middle of the range. Jumbo, on the other hand, is in the top third of where those mortgage rates were over the past 52 weeks. Let's take a moment to talk about delinquencies. And you're probably wondering, like, why are we talking about delinquencies right now? We're talking about mortgage rates. Delinquencies could be a bellwether to foreclosures, and foreclosures could be a bellwether to real estate values if there's a higher increase in foreclosure listings. I have a couple ideas on this, one of which I'll share. Foreclosures historically have always been the contributing factor to lower real estate values, but we find ourselves in different times. And I know there's people that can say, well, it can't be the exception to the rule all the time. We are in exceptional times right now. We've had 2 years of people wondering if we were going to hit a recession. And now we're at the point where I was reading some articles last week and over the weekend that we could be in a recession right now, but in certain industries, and they will roll from industry to industry. I could say the real estate market could be in a bit of a recession right now. I know tech could be. I mean, we're hearing about tech news and, NVIDIA last week breaking records, having crazy market capitalization with investment coming through because of the promise of AI and their chips being what drives that. But there are layoffs happening in the tech space. So there could be recessionary elements happening, but by and large, the economy's not in a recession. The stock market's doing great, always testing the highs. We had a record close over the past couple of weeks. So the economy is doing well by those standards. But let's talk about these mortgage delinquencies. This could be important. If you're 30 days late or more, this data is being captured by CoreLogic. And CoreLogic pulls in all the data and issues reports so that we can see what's going on in the market. And for those who are homeowners that have a mortgage, 3.1% of them are 30 days late or more. Now, that could be contributed to high credit card spending, the holidays. So coming through the holidays, people prioritizing other things other than paying their mortgage. And then boom, we have a 30-day late on record. That is up from 2.9%. 90 days late or more. Now, this is further out. That's 1% of mortgages being serviced, and that's up from 0.9%. So very small increases there, but that can indicate the American homeowner could be struggling right now a little bit. The American homeowner may be feeling the effects of those higher rates on the credit cards and maybe other loans that they've taken out. Buy now, pay later was a big motivator for the sales of all of retail for the holiday season. That can contribute to probably a tightening of the purse and some overextension of where income is going on a monthly basis, which then translates to mortgage delinquency. In foreclosure, that's only 0.3%, and that's remained flat. We talked about that before. We'll just see how that pans out as we continue to keep our eye on the ball here. We're going to talk very briefly right now about the personal consumption expenditure. For the smart kids in class, you'll remember we talked about this. Personal consumption expenditure is the Federal Reserve's preferred inflation gauge. So we're going to pay particular attention to that because that's what the Fed's looking at, who's setting their monetary policy, and they're the ones making the decision when it comes to cutting the interest rates, if and when that will happen. The headline overall was up 0.3% month over month, 2.4 from 2.6 year over year. The core, now this is what the Fed focuses on. This pulls out some data so that they can get a better indication of what inflation feels like to the American consumer, in their opinion. And that's up 0.4% month over month and running at 2.8%, which is from 2.9% year over year as compared to December. So we're still seeing inflation being sticky. Inflation is going to be an ugly battle as it's continued to be here. And until inflation gets within striking distance of the 2% target, we really can't be talking about Fed rate cuts. And we need to just understand the market as it stands and what these rates are from an affordability standpoint, make our decisions from there. Within this, we're going to talk about initial jobless claims, which totaled 215,000 rather, and that's up 13,000 from the previous period and more than what was estimated by about 15,000. Jobless claims ticking up will wind up translating to a higher unemployment rate. If the unemployment rate goes up and there's more jobless claims that come through, it could indicate to the Fed that there's a softening happening and that we can see them possibly make a better case for lowering rates with jobless claims going up. But there's so much dissonance right now. We've talked about this before. The expectations were not in line with reality. The Fed mentioned possible 3 rate cuts, 0.75% cutting of the Fed fund rate, which currently sits at 5.25% to 5.5%. It's always a range and a margin. And the market then started trading as if they were going to be cutting the rates by as much as 1.5%. And there are still some analysts who believe that, but the market's not doing that. The Fed isn't making those decisions. They're not committing to any of that forward rate cut possibility, which now means for us that rates will come up after they dip down and we think, oh, now we have lower mortgage rates. It's not going to be the case. Until there's a Fed cut, until we see inflation consistently lower or continuing to make progress lower, all bets are off. We have to just manage with what we have at hand. Speaking of managing what we have at hand, oh my, let's talk about mortgage insurance. MI, that's what we use as our acronym for mortgage insurance. And I want to take a moment to educate you all on what mortgage insurance is. You think insurance, it's something that's protecting, right? Well, it does protect, but not you as a homeowner. Mortgage insurance is an insurance policy in the event of default on the part of the borrower, aka you as a first-time homebuyer or as a homebuyer. That's what that money goes towards. So essentially, if you put less than 20% down to purchase a home, you're going to need mortgage insurance. And that's an insurance policy that helps to protect the lender. That's also why sometimes you will see a better interest rate for a 30-year or any term mortgage. You may see a better interest rate putting 15% down versus 20%. And that doesn't sound right. You're like, I'm putting more money down. I got more skin in the game. Why am I being penalized for putting 20% down? The answer to that question is that mortgage insurance minimum to avoid it is 20% down. Now the lender's taking on all that risk. Interest rates are risk-based. And so then that gets, quote, priced in, and we see a little bit of a higher interest rate. So that's something interesting to consider. Mortgage insurance operates a couple different ways, and it operates differently with different loan products. So we're just going to keep it simple for today and talk about conventional mortgages and FHA mortgages. With FHA mortgages, we'll start there because it's pretty standardized. The FHA has prescribed guidelines with how mortgage insurance needs to be included in the loan. They have two components, the Federal Housing Administration. There's an upfront mortgage insurance premium. You don't pay that out of pocket. That gets financed into your mortgage. So you don't actually pay it, but it's part of your mortgage loan. And then there's a monthly component to the mortgage insurance. That is standardized based upon your down payment and how long your mortgage term is. And that can vary. But it is standardized by what your down payment is, and how long you have that mortgage insurance is dictated by how much down payment you have. If you put down the minimum for FHA, 3.5%, you will have that mortgage insurance for the life of the loan. If you put more money down, then you could possibly have only 11 years of mortgage insurance for that FHA loan. It's something to consider. That means you need to refinance when the time presents itself to remove that mortgage insurance or replace it with mortgage insurance from, let's say, a conventional loan product. Conventional loans operate a little differently. There's no upfront component necessary. It's possible, but it gets leveraged a little differently. With a conventional mortgage, and you put less than 20% down, your mortgage insurance amount will be dictated by your down payment amount, by your credit score, and by your debt to income ratio. Debt to income is when we compare the proposed debt of the property and all of the debts and liabilities that are present on your credit report and compare that to your gross monthly income. If you have a higher debt to income ratio and a lower credit score and put down a minimum, that's probably going to be your worst case for what the mortgage insurance will cost. Sometimes it makes sense to go with an FHA loan because that mortgage insurance component could possibly be less expensive than a conventional loan. In addition to just being a monthly premium, you do have some other options available to you that not a lot of people discuss or possibly structure for their clients. So I want to give you the inside scoop on this. For a conventional loan, you can elect to pay your mortgage insurance up front, and sometimes that could be at a discount. So if you're putting down 15%, you may not want to pay monthly mortgage insurance. One, there's an opportunity for home values to go up in the future. So if and when the time comes to refinance, you could take advantage of a lower rate. It's very likely your home value will be higher at that time. And so it could make sense to, instead of paying additionally monthly for mortgage insurance, you can pay an upfront premium. Additionally to that, you can do a split premium. You can pay a portion up front and use that to defray what your monthly cost is for your mortgage insurance. When it comes to conventional mortgage insurance, it has varying guidelines as to how long it will be there. The rule of thumb is that once you reach 22% equity, that means your loan to value, the balance of your mortgage, and the value of the home when you purchase it or the last time you obtained financing. When that reaches 78% of the value, or like I said, 22% equity, you can request to have mortgage insurance removed, and then that just falls off. Mortgage servicers will sometimes require an appraisal to confirm the home value, and your likelihood of success in obtaining that would be dictated by how long you've had the mortgage for, and also if you've done any improvements to the property, or is it just market conditions. All of these things will influence how that mortgage insurance request for removal gets handled. That's it for today. I hope that you found all of this useful and helpful. I appreciate you listening and encourage you to share the show with anybody that could benefit from this information. Feel free to reach out if you've got questions. Be sure to like, share, subscribe. I will be back on Friday with another real estate market update. But until then, make it an awesome week and take good care.